Yo, what's going on, everybody? It's Thursday, May 23rd. Big down day, big down day in the market today. I'm not really sure what triggered the down, but we briefly had new highs, at least in the S&P and the NASDAQ, early in the morning, off of that Nvidia earnings from last night. I said that was going to happen. And then the market just the Dow was it was down early, and then Nasdaq and S&P gave up its gains. And again, I'm not really sure what the reason for that was, but let's get into it. As I've been telling you guys, I haven't been comfortable with this rally. I keep saying, or I've kept telling you that I'm not a fan of this rally. And the reasons behind that, my reasons were related to, the core stuff that I look at, which is the fiscal flow situation. And I've been telling you guys that we've seen a drop in net government transfers, AKA the deficit. Net government transfers have been falling. They're down about 180 billion compared to last year. And we've seen that the leading spending flows, although they're very strong, I've said that, that's like the first derivative, they're no longer accelerating when you look at them compared to last year. And they were accelerating in the fourth quarter of 2023. And then for most of the first quarter, I would say half of the first quarter of 2024. They're not accelerating anymore. I don't know if that's really a big deal, to be honest with you, but it's something that I look at, and when I see it graphically, when I chart that out, just to have a visual picture, sometimes it's good to have a visual picture. Picture's worth 1,000 words, right? It just looks like a kind of a slowdown in those leading flows. And again, that's compared to last year, so that's like a second derivative thing. The top line leading flows are still very strong. They're up something like 50 billion over last year. But they're just not accelerating when you look at them compared to last year. And again, I'm not sure if that's relevant or if that's important, but to me, it's just another little item in that fiscal flow picture that when I look at that, and then when I look at how much the market has gone up, and also what I've been telling you guys is that I'm not comfortable with who's buying right now. Okay? I mean, this has been a point that I've been repeating in these last, several videos, or the last couple of weeks, actually. Like, I'm not comfortable with who's buying right now. And by that, I mean, it's all the people who were out of the market or selling or predicting dire events last year because of the rate hikes. And I said those people are going to be all wrong. It turned out they were all wrong. I was right. I was telling you that the rate hikes were a fiscal operation that would equate to higher government transfers, interest income transfers. And that's actually what happened. And now that same, universe of people who were negative last year, they're all piling into the market right now like, it's a stampede. And I said, maybe they're going to be right, but I'm not comfortable with that kind of behavior. When I see that kind of behavior, people who were, wrong, and it's not only, it's one thing to be wrong, but it's another thing to have, like I've been saying, to have a model that you base your outlook on. And then when that model doesn't work, when it turns out to be wrong or erroneous, you just kind of ignore that fact, but use the same model as a justification to say now the market is going to go up. I mean, to me, that's illogical. And everything, and what I try to do is look at the market in a rational way, or look at, not the market so much, but to look at the economic conditions rationally. Like, what's driving it? What is out there in terms of looking forward, okay? And then making a forecast off of that. I can't say like, okay, this didn't work this time, but I'm going to use that same thing now to predict now what's going to happen in front of us. Not even examining the reason why that model that I had or that they had was wrong in the first place. Anyway, I don't want to get too, deep into the conversation of this thing. It's just that I've been saying that I'm not comfortable with this rally. Now, we still have next week first of the month payments coming up. Actually, somebody pointed out to me, and that's right, I forgot. June 1st falls on a Saturday. Okay, so we're going to get those first of the month payments will be split between Friday, next Friday, the 31st, and Monday, June 3rd. Which is, it's not really that important. The important point is that those first of the month payments, right, those big payments, which are Medicare, Medicaid, military pay, veterans benefits, disability, all that stuff, which is usually like 120 billion leading flow, that's going to come out at the end of next week. And that should lend some support to the market. But then we get into June 15th, which is the tax drain again. It's not going to be as big as the April 15th tax drain, which, by the way, like I said yesterday, I don't know when we still have like 190 billion or something to recover off of that drain. That'll be cut significantly by the end of, the first of the month payments, but it's still going to be negative. And then we're running into another drain on June 15th. So this is why I said yesterday, I said, to me, the market is very speculative. I also pointed out recently, and it's not something I normally do, but I said when you look at the PE ratio of the S&P 500 right now, which is around 25, the earnings yield, what is the earnings yield? It is the inverse of the PE. So if you take 1 divided by 25, you get 4%. That's basically what all the stocks in the S&P 500 are yielding in terms of their earnings. And I said, presumably that is the reason, that is the justification for you to invest in stocks. Like you're buying a little piece of a company on the assumption that you're going to participate in their profits, okay, their earnings. And the stock price usually reflects that over time, okay? That is the beauty of the stock market. You may not have the money to buy an entire business, but you can buy a little piece of that business or many businesses, over a diverse portfolio and participate in that earnings yield. 4% earnings yield right now when you can get 5.5% in cash sitting in the bank. I don't see what the great attraction of that is, to be honest with you. Now, again, my core analysis is based on the fiscal flows. That's like what drives everything. Okay, that's the first derivative of what drives everything. But I have to look at other things too. I look at sentiment. I just spoke about that in terms of I don't like the cohort that is buying into the market right now. And then I look at valuation. I have a video course entitled MMT Stocks, MMT and Value Stock Selection. It's on my website for $99. And the core of that course is a combination of just MMT, macro understanding of the economy, and value. How do you pick stocks? On the basis of valuation and on the basis of sentiment. Those three elements that I just talked about. So the stock market generally right now, the value, if that was a stock, an individual stock, the S&P, I wouldn't be buying that right now. Unless it's a growth, like a growth stock, I make some accommodations if it's a growth stock. Like you look at something like Nvidia, right? It's growing like crazy. AI is the big thing right now. So you can have earnings yield much lower because it's still in the growth phase. But the economy is slowing down. All right, we had a 1.6% GDP growth rate in the first quarter. And I keep telling you guys, I think it's going to be that, maybe less in the second quarter. I think I'm the only one saying that. I mean, Atlanta Fed has the GDP second quarter at 3.6%, but they revised it down 2 times right now. They had it at 4.2%. And for the life of me, I don't know. And they're usually pretty good. I have to say, the Atlanta Fed with their forecasts are usually pretty good. I don't know how in the world they came up with a 4.2% growth rate. Anyway, they revised it down to 3.6, and I think they're going to end up revising it down more. The point is, the S&P right now, for me, it's not a growth stock. The economy is not growing that rapidly, and that's because these government transfers are falling, okay? And a 4% earnings yield, when I could have my money in the bank earning 5.5% in cash, I mean, it doesn't take a genius to figure out that that's not a good deal for me. I mean, maybe for you guys because you chase after everything. For me, it's not a good deal. So I have been raising cash into this rally. It's something I've been talking about for several weeks now. And we'll see what happens. But today was something. I mean, I don't know, again, what triggered it. I don't know what triggered it. But even if there wasn't one specific thing that triggered it, when you get a market that is overvalued and that it has become highly speculative, like I've been saying, like stuff like this could happen, all right? Everybody piled in. These are weak, mentally weak investors, and also investors who just have the wrong playbook, okay? These are all the people from last year who were telling everybody, and again, yesterday I said, it's not just individual novice investors that are jumping in, okay? They maybe are even jumping in less than the so-called pros on Wall Street, who were advising universally everywhere on Wall Street last year. They were advising universally recession, crash, market downturn, rates, disaster, blah, 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 all this stuff. They're the ones jumping in right now. They are the ones jumping in right now. Don't look at these people, folks, and think that they may be smart in the sense of being book educated. I'm sure they all went to very fancy schools. That doesn't mean anything, okay? It's their behavior, the things they talk about, their closed-mindedness. It reminds me a lot of a cult mentality, because that's what it is. When you have this kind of, follow me, universal kind of thinking among a group think, and at times, or when that group think turns out to be wrong constantly, and the group doesn't change their thinking, that is like a cult mentality. That's the same thing. Any psychologist would tell you that, and that's what's going on right now. Those are the people now buying and advising you to go in. Think about it. 4% earnings yield in the S&P 500. Put your money in a bank in cash, you're getting 5.5%. I mean, a kid could figure that out. All right. Anyway, that's it for today, folks. Don't forget, please like and subscribe this video. It helps me out a lot. It helps us all out a lot if this channel, does better. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I show you how to use that to trade and invest profitably in the financial markets. See you tomorrow. Bye.